The European Union's crypto regulation machine is in full swing. The European Securities and Markets Authority, or ESMA, is rolling out fresh guidelines aimed at ensuring crypto professionals actually know what they are talking about. But what does this mean for exchanges, investors, and the wider crypto landscape? Let's break it down in detail. On February the 17th, so just 3 days ago, the ESMA released a consultation paper seeking feedback on new guidelines for assessing the knowledge and competence of staff at crypto asset service providers. Now, these guidelines aligned with the Markets in Crypto Assets Regulation, or MiCA, which is part of the EU's ongoing effort to standardise and regulate the rapidly evolving crypto industry. But why is this happening now, and what are the implications? So MiCA was published in June 2023, and since then regulators have been working on detailed frameworks to ensure that firms operating in the crypto space meet higher standards. And this latest move is aimed at making sure that professionals within the sector truly understand the assets that they are dealing with. And these guidelines are crucial because crypto is still seen as a Wild West by many regulators. And by enforcing competency standards, the ESMA is hoping to bring more legitimacy to the sector. So what exactly is ESMA proposing? Well, the new guidelines set minimum knowledge requirements for crypto professionals, particularly those providing investment advice or information to clients, which will include things like having a deep understanding of crypto asset risks, market structures and pricing. You're going to have a familiarity with blockchain technology and also how it operates. Other things like knowledge of regulatory frameworks, including things like tax implications, and also an awareness of the unique complexities and volatility of different crypto assets. Crypto is not like all the other sectors in finance, and so these measures are designed to protect investors from misinformation and poor advice. And because the crypto industry has often been criticised for a lack of professionalism, shall we say, and these guidelines are trying to change that. And we've seen the consequences of uninformed decision making in the crypto space before, whether it's fraudulent ICOs to major exchange collapses. Lack of proper knowledge it just costs investors billions. And so what ESMA is trying to do here, they're trying to prevent this history from repeating itself. Now, ESMA isn't just stopping at general knowledge, they're actually trying to push for minimum qualifications here. So that means that relevant academic degrees, prior experience in the field, and ongoing professional development. So essentially, if you're advising people on crypto like this, then you're going to need to be qualified to do so. And you're going to have to stay updated as well as the space evolves. Now, one of the key aspects of this initiative is ensuring continuous education because, crypto markets evolve rapidly. And what was true just 1 year ago, as we all know, may no longer be relevant. So advisors are going to need to prove that they are staying up to date, much like financial advisors in traditional finance sectors. And with major exchanges like OKEx, Crypto.com and Bybit, who are already working to secure these MiCA compliant licenses, and in fact I think Crypto.com and Bybit have already been issued their licenses to work within Europe. It just means that this latest move further tightens regulatory oversight, and the consultation period is open until April the 22nd, and ESMA is actively seeking feedback from industry players. So, the final guidelines are expected to be published in, I think it's the third quarter of this year. And we've got some firms that are welcoming this initiative, saying that it'll bring much needed credibility to the space. You've got others that are worried about, that it can make compliance too expensive for smaller companies, which potentially limits competition, which is never a good thing. But the big question is, whether these regulations are going to create a safer market, or are they just going to add more bureaucracy? because regulatory compliance isn't cheap and firms may need to invest in training programs. They're going to have to hire specialized compliance officers and undergo continuous audits. And so whilst in the end, it's trying to benefit consumers, it can end up creating barriers to entry for smaller startups. And this is actually coming on the heels of ESMA's recent warning about non-MiCA compliant stablecoins, including Tether's USDT. Some exchanges have already rushed to delist the stablecoin, prompting frustration from Tether. This is signalling that the EU's increasingly strict stance on crypto assets that don't meet their regulatory criteria. And, the crackdown on stablecoins is part of a broader effort to ensure financial stability. That's what the European Union will be arguing anyway. But it does raise questions about whether regulators are moving too fast. Are they stifling market innovation? And Europe isn't the only region tightening regulations. We've got the US, the UK, and even crypto-friendly jurisdictions like Singapore are ramping up oversight. Are we heading towards a world where crypto is becoming fully institutionalized? And so what does this mean for you, and what does it mean for the average investor? Well, on the one hand, these regulations are aiming to enhance consumer protection and ultimately trust in crypto markets. And on the other, some are arguing that this could be seen as excessive red tape, it can slow innovation, and it can make compliance more expensive for smaller firms. What do you think? Are these guidelines a necessary step to professionalize the industry, or are they just another layer of bureaucracy? Let me know in the comments. And don't forget to like, subscribe, and hit that notification bell for more updates on crypto regulation and crypto news. Thanks for watching, and I'll see you in the next video.